we are now going to summarize the most important points from this particular reading. The first and perhaps one of the most significant items to understand is that the growth of an economy has a lot to do with investment returns. And therefore, when you as an investor are trying to figure out which economy to invest in or which area to invest in, doing an analysis of the growth, the economic growth, is important. As we'll see later, the stock market returns are heavily correlated with the economic growth of a given economy. So if you are making an investment in a particular country or a particular region, you want an assessment of whether that region will grow or not. How do you do that? You need to consider several growth enabling factors. So what are those growth enabling factors? Why do you study this material? You study this material because you want to see whether those factors are present. If these factors are present in a given economy or a given country, that would imply that the chances of growth are relatively high. So what are those growth enabling factors? One is savings and investment. The relationship here is fairly straightforward. If the amount of savings is relatively high in a given economy, if the private savings is high, what happens to savings? The money gets invested, and if the level of investment is high, that stimulates economic growth. So this is one growth enabling factor. Another factor is financial markets and intermediaries. If you have well-developed financial markets in a given region or a given country, that also enables or facilitates growth. Because with well-developed financial markets, money flows or funds flow to the most useful purpose, and that obviously helps with growth. The third item, or the third growth enabling factor, is political stability, which goes along with rule of law and property rights. So this is fairly straightforward. Obviously, in a country where there is political stability and rule of law, money will flow in more easily. You can think of this in reverse. In a country where there is a lack of political stability, the rule of law doesn't exist, clearly investment money is not going to flow in. The fourth point is education and healthcare systems. This is a general point, but clearly in a country or a region where the level of education is high, that means the quality of labor is high. In those countries, the growth will be higher because higher education implies a higher level of productivity. Higher level of productivity implies higher growth rates. A good healthcare system is fairly basic. Obviously, if people are healthier, then they work better. If people work better, then there is more economic growth. The next is a good tax and regulatory system. If there are good regulations in a country, that facilitates growth. If the regulation is weak or poor, that obviously limits growth. And finally, free trade and unrestricted capital flows. As we've seen at level 1, when there is free trade between countries, then what happens? Then countries tend to produce goods and services where they have a comparative advantage. And when countries do that, then obviously they perform better. Overall, companies can have higher profits if they are operating in industries where the country has a comparative advantage. And unrestricted capital flow simply means that it is easy for money to come in and fund projects, which again stimulates growth. So from an exam perspective, these 6 factors you need to understand and learn well. In fact, the first thing you need to do is just learn these factors, and then it is fairly self-evident why each of these factors enables growth. The curriculum also talks about the factors which inhibit growth, and rather than remember another list, you can simply think that all the factors that I just listed, if those either don't exist or are in a negative form, then that would hinder or limit economic growth. So that's the first important point. The next point has to do with the relation between long-run stock market appreciation and sustainable economic growth rate. Here there is a fundamental formula or relationship that you need to understand, and that is given right here. The price level, this refers to the price level of your equity market. This is equal to GDP into E over GDP, and I'll explain what each of these terms mean, multiplied by P over E. Now, algebraically, you can see that this is an equality because GDP and GDP would cancel out, E and E cancel out. P, as I said, is the price level of your equity index or overall equity market. GDP is your gross domestic product, so that's a measure of the output of an economy, multiplied by E. This refers to the aggregate earnings or profits of companies in an economy, divided by GDP times P, this again is the price level, over E, which is the aggregate earnings. So what do you see over here? The growth rate of the price level or the growth rate of your equity index depends on the growth rate of GDP and the growth rate of this ratio, aggregate earnings divided by GDP times the PE ratio. The point here is that these two ratios are mean reverting. Is it possible that the price earning ratios keep increasing? No, it is possible that they go up, but when they go up, they'll also come down. So in any economy, there will be some mean level for the PE. It will not keep increasing indefinitely. What about the earnings to GDP ratio? That also is mean reverting. So if on average, these two ratios are at a particular level, then what does the growth rate of your equity index depend on? It depends on the growth of your overall GDP. So that demonstrates the fundamental relationship between long-run stock market appreciation and the sustainable economic growth rate. A quick refresher from level 1, what does the sustainable economic growth rate mean? This is the growth rate at which your potential GDP is growing. The overall economy is growing at a certain rate over the long run. That's what we are talking about over here. Is it possible that in the short run, the equity market grows faster than the growth rate of the GDP? It's possible in the short run, but not in the long run. Unless, of course, there is some fundamental change in the economy and now we have a higher level of earnings per GDP or a higher level of price per earnings. Unless something fundamentally changes, these two will change at the same rate. The second bullet point illustrated the relationship between long-run stock market appreciation and growth rate. What about the perspective of a fixed income investor? Here is how you think about fixed income investors. So imagine you've purchased a bond. All right, now you look at the potential GDP growth relative to actual GDP growth. Is it possible that actual GDP is growing faster than potential GDP? It can happen sometimes, and this is connected with what you've studied at level 1. In a scenario like this, you will have inflationary pressures. So in the short run, at least, your economy is growing at a rate higher than potential GDP. So this will create inflationary pressures, which means inflation numbers are going up. When inflation numbers go up, that means that the value of your fixed income investment comes down. If you think about it, with a fixed income investment with fixed coupons, now the present value of those future coupons is becoming less. That's one way of looking at it. The other way of looking at it is with higher inflation, you are losing out because you as an investor will get the same coupon, the same amount of nominal money, but obviously the buying power of that money is going down because of inflation. So that is one area to consider. The other area that you as a fixed income investor need to consider is the following. If you have high potential GDP growth, is that a good thing?
Yes.
So high potential GDP growth, this means that the actual economy is growing at a faster rate. And when we say potential GDP growth, this is more sustainable. So when this happens, then the real interest rates will be higher. All right, so if real interest rates are higher, then we as fixed income investors or investors in general will expect higher real returns, right? So that is something else to keep in mind. Next point, what is the impact of capital deepening investment and technological progress on economic growth and labor productivity? Okay, now here are some important points that you need to be aware of. I'm going to explain this basic relationship. Your output is a function of capital and labor. Now, what does this mean? The total output of a given economy depends on the amount of capital, denoted by uppercase K, and it also depends on the amount of labor. All this is saying is that output is a function of capital and labor. So far we've not said what that function is. And then output also depends on A. A stands for total factor productivity. This is the level of technology. And technology in economics is used in a very generic and broad sense. Anything that improves productivity is called technology. So this is your basic relationship. Now, one particular equation that is derived from this is called the Cobb-Douglas function, and I will write that out for you. The Cobb-Douglas function is taking this particular function and actually giving it some form. So this is how it goes. Y is equal to A multiplied by capital to the power of alpha, and then labor to the power of 1 minus alpha. We are simplistically assuming here that the output of an economy just depends on these two factors. But clearly you can have more complex models which have more factors. Now in this relationship, you've already understood A and K and L. Now you also need to understand what alpha means. Alpha is the share of output paid to capital. The total amount of output is the same as the total income. You learned this at level 1. The percentage of that output or income that is paid for capital is denoted by alpha. Then what is 1 minus alpha? It is the percentage of the income that is paid to labor. Just to give you a sense, in the US, alpha is approximately 0.3, which means that 30% of the total output or the total income goes towards paying for capital. And then 1 minus alpha would be 70%. That is the amount that goes to labor. All right, so this is one particular relationship. You also need to understand this concept of labor productivity. Labor productivity is your output per unit of labor. The higher this number, that means your labor is more productive. In countries like the United States and Germany, this number will be high. In countries like India and Bangladesh and Pakistan, this number will be relatively low. Now, what does this become? If we continue with the Cobb-Douglas function, this becomes A into K over L to the power of alpha. So you don't need to understand the detailed derivation, but very simplistically, the labor productivity depends on the level of technology. What is the other term for the level of technology? It is total factor productivity. Clearly, the higher the value for A, the greater the productivity. And then what is K over L? This is the capital per unit of labor. What this is saying is that the higher amount of capital you have per unit of labor, the greater the productivity. In developed countries like Germany and United States, this ratio will clearly be higher than less developed countries. All right, so you need to know this relationship and you need to know this relationship. Now, what do these terms mean? Capital, deepening, technological process, and so on. I'm going to explain this through a graph. So here is a simple picture from the curriculum. Let's say on the y-axis you have capital per unit of labor or per worker, and then on this vertical axis you have output per unit of labor or per worker. Now, as you move from left to right, what is happening? The capital per worker is increasing. If you have more capital per worker, will the output increase?
Yes.
It will. And we'll have a picture like this. What is this picture saying? This is saying that as you add more capital, for example, you are working in an economy where the farmer is simply using a bullock cart, right? So that is his capital. As you move to a tractor, what's happening to capital per labor? It is increasing. What is happening to the output per laborer? That will increase. But as you keep adding more tractors, will the output keep increasing linearly, or will there be a diminishing returns? There will be diminishing returns. As we move along this curve, we say that we have capital deepening. Do you see where the term is coming from? Capital deepening simply means more capital per user or more capital per worker. Right? So moving along this is capital deepening. Now, what if you have a certain number of tractors per laborer, but now your tractors become more efficient? Then what is happening? When the tractors become more efficient, your A, or total factor productivity, increases. So what happens to this function is that it shifts up. Right? So you move along this function as long as technology is staying constant. If technology or total factor productivity or the A that we talked about in our previous formula, if that increases, then the function shifts up. So now here is a question that you might get on your exam. Let's say that we are currently at this point, and then over time, let's say over the next year, then we move from point A to point C. This move can be explained in terms of capital deepening and in terms of additional technology. If A is 100, I'm just picking numbers here, and then we come to B, let's say B is 120. The move from 100 to 120 is explained by capital deepening. And what about the move from B to C? Let's say that this is 130. The move from B to C is explained by better technology or increased technology. Right? So now you can see this particular statement. What is the impact of capital deepening on economic growth and labor productivity? The greater amount of capital deepening, then your labor productivity increases. If labor productivity increases, obviously that stimulates economic growth, but there is diminishing returns. What is the impact of technological progress? What's the impact? There also, when you have technological progress, then the output per worker improves. So labor productivity improves, and therefore the economy is stimulated. Next point has to do with growth accounting relations and potential GDP forecasts. All right, now here is something else that is extremely important and extremely testable, and make sure you know this. There are two relationships here that I'll describe, and both are very testable. The first one goes as follows. The change in Y over Y, what is Y? The output. And what would change in Y over Y be? It would be the percentage change in output. Expressed as a fraction, but clearly you can change this into a percent. This is given by percentage change in total factor productivity or percentage change in your technology plus the percentage change in K over K and multiplied by alpha. What was alpha? Alpha was the percentage of income or output allocated to capital. Alpha is for capital, and then you would have plus 1 minus alpha times percentage change in labor. All right, so this is a very fundamental relationship. It's actually an approximation, but it is something that economists and investment managers use quite a lot. What is this saying? That your percentage change in output of a given economy depends on these three variables. And in a sense, we saw this in an earlier equation, but this particular equation is easier to digest than the Cobb-Douglas relationship, which uses exponents and so on. This relationship also illustrates another interpretation of alpha. Alpha can be thought of as an elasticity. Let's say alpha is equal to 0.3. And then I tell you that the technology is not changing. And we are in a country like Germany where the labor is fairly stable. So how does a country like Germany grow? There, if we have a relationship like this, percentage change in K over K. So if there is a 1% change in capital, what is the percentage change in output? 0.3%. So that means that the alpha can also be thought of as an elasticity. If capital is constant but labor changes by 1%, then what will the percentage change in output be? Then it would be 0.7%. So I think this is extremely testable. Make sure you know this relationship. The other important relationship is as follows. The growth rate in potential GDP is equal to the long-term growth rate of the labor force, so long-term growth rate of labor force plus the long-term growth rate in labor productivity. You don't need to worry about the derivation, but I hope this makes intuitive sense. So growth rate in potential GDP, do you think if the labor force is increasing, that will cause the GDP to increase? Yes. Obviously, if there are more people working, then the output will be more. And then what if people are more productive? So workers are more productive. If the productivity increases but the number of workers stays the same, will that cause the GDP to increase? Yes. Yes, obviously. So this is another way of looking at it. Now, how does this connect with what we are talking about earlier? If you look at this item over here, the growth rate of labor productivity, what does that depend on? What are the two? Yeah, so this clearly depends on capital and technology. So this then connects with what we discussed earlier. So so this is actually taken from the learning objectives. You need to know how to use the growth accounting relations and use them to predict GDP growth rates. So you can see that over here. If you can predict the growth rate of labor and you can predict the labor productivity, then you can also predict growth rates in GDP. So this is quite powerful. But from a testability perspective, it is essential that you know this relationship and then this particular relationship. Next point. What is the impact of natural resources on economic growth? If you have a country like Saudi Arabia or Kuwait, which has a tremendous amount of natural resources, does that stimulate economic growth? Yes. The answer is yes. So having natural resources, and with natural resources you can have renewable and non-renewable. A renewable resource would be farmland. Non-renewable would be oil and gas. But in any case, countries that are rich in natural resources have an advantage. But here is another important question. Are natural resources essential for growth? The answer is no. If you look at a country like Singapore or countries like Japan and South Korea, they don't have a lot of natural resources, and yet their growth rates have been faster than the growth rates of Saudi Arabia and Kuwait. So the point is that while natural resources help, they are not prerequisites for growth. Again, important to know that fact from a testability perspective. All right, continuing with our summary. What is the impact of demographics, immigration, and labor force participation on the rate and sustainability of economic growth? So there are some core points over here, and most of these are self-evident. What does demographics mean? This essentially deals with the rate at which population is changing, how the population mix is changing, and so on. Okay, so now let's look at the factors. If you have the population increasing, what will that do to economic growth? That will stimulate economic growth. If you look at a country like Canada, that encourages immigration, and they try to define what sort of immigrants to accept, but the point there is to have the population increase so that the output of the country increases. All right, so that connects with immigration. What does labor force participation mean? This means that you have a certain working age population. Is it necessary that the entire working age population is in the labor force? No. The percentage of the working age population that is in the labor force is given by the labor force participation ratio. Now, the higher this ratio, obviously the higher the output. So you need to recognize that fact. The curriculum gives a few good examples which show you how this material how you can be tested on this material. If you think of two countries which are very similar, and you are told that in one country, the percentage of women in the workforce is high, whereas in the other similar neighboring country, the percentage of women in the workforce is relatively low. So here you have high percentage of women working, here you have low percentage of women working. What you might be able to predict is that the potential for growth is higher over here, because if the countries are culturally similar, then there is a higher chance that the labor force participation ratio will increase in this country. As more women enter the workforce, what will happen to the labor force participation ratio? That will increase. When that increases, what will happen to the output of that economy? That will increase. So you need to understand the concept, but you need to practice some questions to understand how you will be tested. Another basic item: how do you think an economy will be impacted if the average working hours in a given economy increases? People are currently working 37.5 hours a week, but you expect that number to increase to 40. Again, that will also increase the output. Next point: what is the impact of physical capital, human capital, and technological development on economic growth? This is taken from the learning objectives, but if you think about it, to some extent we've already studied this material. What is physical capital? In this particular segment of the reading, the curriculum distinguishes between two types of physical capital: ICT and non-ICT. What is ICT? This is information, computers, telecom, etc. And what is non-ICT? This would be your industrial equipment, for example. So anything that is not information technology based. Why is it important to distinguish? The reason is that with ICT, the externalities are very high. In an economy where there is a high use of information technology or high level of technology, the benefit to society tends to be a whole lot more than non-ICT. So the thing to remember is that externalities are relatively high, and I'll get back to this point later. The overall thing to remember here is that if the level of investment is high, then that means a higher level of productivity. So that is the impact of physical capital: higher productivity and higher economic growth. What about a higher level of human capital? What does this mean? Higher human capital doesn't mean more people. In this context, it means more educated or better trained people. So how does a country improve human capital? Through better education, better training. What does that do to economic growth? that also stimulates growth. And technological development, what's happening here? The total factor productivity, this is increasing. Do you think there is a link between ICT and total factor productivity? So a higher level of ICT would imply a higher level of total factor productivity, right? So all these impact economic growth. Next point, there are different theories of growth. Now, what do these theories try to do? They try to explain why there is economic growth. And many students find this a little bit difficult. So what I'll do is, I'll highlight the most important points that you need to know. So you need to know these three theories: the classical model, the neoclassical model, which is also called the Solow model, after the economist who defined this particular theory, and then the endogenous growth theory. So what is the most important point associated with each of these theories? The classical theory, this is the one that was originally proposed. This says that the growth in real GDP per person is temporary, and when the growth per person rises above a certain subsistence level, then there will be a population explosion. So the output will be higher, but because of the population explosion, the output per person will come back to where it started. And it is easy to understand this in a farming context, that you have a particular farmland which supports a certain number of people. If that particular community has excess number of children, there is not enough food to feed them, so the kids will die. But if because of better technology the farmland can produce more, then what will happen to the population? If more people can be fed, there will be more people. And what will happen to the output per person? That will come back to where it was, right? So simplistically, that is the classical model. But over the years, we've seen that this doesn't hold. We see several countries where there is economic growth and the output or the income per person has gone up. So while the classical model has something to say, but we do not take it too seriously. Next, we come to the neoclassical model, which actually gives us hope. The classical model doesn't give us any hope, because the classical model says that no matter what happens when there is an improvement in technology, there might be a short-term benefit, but we are back to square one. The neoclassical model says that if there is an improvement in technology, then we do get to a higher level of output per person. Now, there are a few core points that you need to know. So there is a relationship that is extremely important. That relationship, from a testability perspective, you need to know the growth rate of output per capita or per person is given by theta over 1 minus alpha. You already know the alpha. This is the percentage of income that goes to capital. So 1 minus alpha is the percentage of income or output that goes to labor. The theta you've not seen before. This is simply the percentage change in total factor productivity. Total factor productivity has been denoted by the symbol A. So what this is saying is that if your alpha is constant, which means 1 minus alpha is constant, you can still have a growth rate of output per capita if your technology is improving. So technology is critical to this particular model, but this model does not explain how technology works. It simply says that if the technology is better, then the output per capita will improve. So you need to learn this relationship. Now, what about the growth rate of the overall economy? How do we deal with that? The growth rate of the overall economy is given by this: theta over 1 minus alpha plus n, What is N?
Population.
N is the growth rate of population. So if you think about it, we are saying that the growth rate of the overall economy depends on the growth rate of output per capita or per person, and it also depends on the population. So if your population is increasing, that's denoted by N, and if the output per person is increasing, that's denoted by this, theta over 1 minus alpha, which we saw before. The next point that you need to understand is something called the convergence hypothesis. And this is straight from the learning objectives. So with convergence hypothesis, there are two flavors. One is called absolute convergence and the other is called conditional convergence. You need to know the definition of both. First, let's just take this absolute convergence. The theory is that developing countries will eventually converge with developed countries in terms of per capita growth rates, not necessarily in terms of income levels. And the idea is this: if we look at a relationship that we saw earlier, where this was the output per worker and this was the capital per worker, then a country like Germany would be up here, which already has a fair amount of capital per labor. And you have other countries like India, which are over here. At this stage, add more capital, will their output increase at a faster rate? So their output will increase at a faster rate. So according to the absolute convergence theory, they will eventually catch up in terms of per capita growth rate. But we have seen that there are countries which seem to be on track in terms of catching up with more developed countries, and then there are others which do not. So there are some countries that just do not seem to be on that track. So there this other theory comes in, which is called conditional convergence. What this theory says is that convergence is conditional on both countries having similar factors. So similar savings rates, similar population growth rates, and similar production functions. Do you remember an example of a production function? So this is a production function. This depends. So what is an example of a production function? So Cobb-Douglas would be one example where we said y is equal to a into k to the power of alpha and L to the power of 1 minus alpha. So according to the conditional convergence theory, this function needs to be the same for both countries for them to converge. So clearly, conditional convergence seems to be more practical. Also keep in mind that while some countries are converging, there are other countries which are stuck in a non-convergence trap. So they might not have the growth enabling factors. They might not have a good production function. So whatever reason, there will be some countries that are stuck in a non-convergence trap. The next point: what is the economic rationale for governments to provide incentives to private investment in technology and knowledge? Now, this is a very fundamental point, and this connects with something that we discussed over here. Technology generally has a high degree of externalities. So there is a benefit to the company that develops the technology, but then that technology can be used by other companies in the industry, maybe by other entities in that particular economy. So the overall economy benefits. However, when a company makes decisions about how much to invest in technology, do you think they are considering the externalities and the broader benefit to society, or they are only looking at their own perspective? Companies will only look at their own perspective. So if you look at the overall economy, will the investment in technology be sufficient? And I'm going to connect this with something you saw at level 1 economics. The optimal level is where the marginal cost is equal to the marginal benefit. A company will only look at its own marginal benefit, not at the marginal benefit to society. Where there are externalities, the marginal benefit to society is a lot more, right? So clearly, if there is no government intervention, then the amount of investment in technology will be less than what it should be, right? So what should the government do? The government should then subsidize technology. So that is the economic rationale. The government should subsidize technology so that companies develop technology that will then have the externality effect. The same for knowledge, right? So the more knowledgeable your society, the better educated that society will be, the better it is for the overall economy. Will each individual company think that way? Obviously not. A company is only looking at its own limited perspective. So a company will have its training programs and so on, but they will under-invest in knowledge. So it is the responsibility of the government to subsidize or to make investments in both technology and knowledge. Knowledge being education and training. The final point is the impact of removing trade barriers on capital investment and profits and so on. Now, here is a very basic relationship. If the trade barriers are reduced, what will happen to capital investments? The capital investments will increase. If you recall your level 1 reading on trade, what happens when trade barriers are removed? What happens is every country then spends more money on developing the industry where it has a comparative advantage. So the industry where a country has a comparative advantage becomes bigger. The investments or capital investments increase. And when there is free trade, then countries can sell their products at higher prices in overseas markets. So what will happen to profits? Profits will go up. With industries that are growing and profits that are increasing, what happens to employment and wages? They also increase. And what happens to the overall economies? They also increase. So it probably will not surprise you that economists will generally promote removing trade barriers. Okay, so that is what you need to remember. So that's it in terms of this reading. As I keep saying, I want you to review the summary for this reading, go over the examples. The learning outcomes are extremely important. After doing the reading, I want you to actually go through the learning objectives and see if you can respond to them. And to some extent, the summary will help you with that. Do the practice problems in the curriculum and also try to do practice problems from other sources.